Discover what happens when an estate cannot pay inheritance tax immediately and learn the lawful options available under UK tax rules.
You've just inherited a £1.5 million estate. On paper, it looks like a significant windfall, mostly tied up in a family home and unquoted business shares. But when you check the bank accounts, there is zero liquid cash. This creates a circular problem. HMRC requires inheritance tax to be paid before issuing a grant of probate. However, as executor, you lack legal authority to sell the house or shares to raise money until you have the grant. For S&E directors, the pressure is higher. You have a legal responsibility to protect the estate's value, yet you may find yourself considering whether to use your own company's operating cash just to satisfy HMRC and get the process moving. I'm here representing ProTax Accountant. We specialize in UK business tax planning and compliance, helping executors navigate these specific estate liquidity issues. Today, we are breaking down the specific funding mechanisms available to resolve this situation under the current 2026 UK tax rules. Stalling the process creates a financial drag on the estate. Every month that passes without settling the bill allows interest to accumulate, directly reducing the total inheritance left for the beneficiaries. The clock starts ticking immediately. HMRC expects the inheritance tax bill to be settled by the end of the 6th month after the month of the person's death. This chart shows the cost of waiting. The bottom line tracks the Bank of England base rate. The top line, staying 2.5% above it, is the HMRC late payment interest rate at 8.25%. This interest is calculated and compounded daily on unpaid tax. On a $400,000 tax bill, delaying payment by just 6 months adds over £16,500 in interest charges to the final liability. Simply doing nothing is rarely the right strategy. To protect the estate's equity, you have to choose between using HMRC's own relief schemes or looking into commercial borrowing. The first option to investigate is the Direct Payment Scheme, or DPS. You complete Form IHT 423 and send it to the deceased's bank. This allows the bank to move frozen cash directly to HMRC to cover the tax bill, even before you have probate. This is a zero-cost solution. There are no interest charges or setup fees, and if the cash covers the bill, HMRC will confirm the payment to the probate registry so the grant can be issued. However, this only works for liquid cash held in participating UK banks, building societies, or NS&I accounts. If the estate's value is entirely in property or unquoted business shares, the direct payment scheme cannot help you. For estates with limited cash, you can elect to use the HMRC 10-year installment plan via Form IHT 400. This applies to specific installment option property, which legally includes land, residential or commercial buildings, and unquoted business shares. This chart illustrates the primary benefit. You only need to raise the first 10% of the tax bill to satisfy HMRC and obtain probate. The remaining 90% is then paid in annual installments over a decade. There is a cost to this deferral. For most property assets, HMRC still charges that standard 8.25% interest on the outstanding balance throughout those 10 years. This is an important consideration due to the 2026 rule changes. With business and agricultural property relief capped at £2.5 million, more family businesses will find themselves using these installment plans to manage their liabilities. Note the acceleration clause. If the property or business is sold at any point before the 10 years are up, the entire remaining tax bill becomes due in full immediately. This provides necessary breathing room, but it essentially keeps you in a long-term debt relationship with HMRC until the asset is finally realized. Option 3 is a specialized liquidity bridge, the commercial executor loan. This is a credit agreement secured against the estate's assets. Since the lender is looking at the estate's equity, they typically don't require personal credit checks or personal liability from the director. The lender sends the funds directly to HMRC, allowing you to move forward with the grant of probate. These loans feature rolled-up interest, so the estate doesn't have to make any monthly repayments while the assets are being sold. This chart compares the cost of capital. While HMRC charges 8.25%, specialized executor loans often carry a representative APR of around 19.6%. In a practical example, a £50,000 loan held for 1 year results in nearly £10,000 in interest. That cost is paid directly from the final proceeds before the beneficiaries receive their share. This route removes administrative friction with HMRC, but the 19.6% rate means the debt grows significantly every month. If the property sale takes longer than expected, the mounting interest can consume a substantial portion of the estate's equity. If the estate has no cash and you prefer to avoid high-interest commercial loans, you can apply for an HMRC grant on credit. This is an arrangement where HMRC allows the grant of probate to be issued before the tax is paid. This legally enables you, as the executor, to sell the estate's physical assets to cover the final tax bill. Because this is a last resort, HMRC requires substantial evidence. You must submit a detailed financial hardship letter, prove that you have exhausted all liquid options, and sign a binding repayment timeline. You will be under close oversight. HMRC usually requires proof that the property is on the market with an accepted offer, and they may register a legal charge against the house to protect their claim. Standard HMRC interest of 8.25% still applies during this period. The grant on credit delays the payment, not the interest calculation. This avoids the 19.6%. As an SME director, you should not move toward high-interest commercial lending until you have rigorously tested whether the estate qualifies for HMRC's installment or credit options. Managing these rules, especially with the 2026 caps on business property relief, requires a clear tax strategy to protect the final value of the inheritance. If you are acting as an executor, contact ProTax Accountant today. We can help you map out the most efficient way to fund your inheritance tax bill. Subscribe to our channel for more definitive guides on UK tax compliance and business planning. This video is for informational purposes only. UK tax rules and interest rates change frequently, and you should seek professional advice for your specific circumstances.